And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider.
And we've tried to put in the annual report pretty much how we approach securities, and book value is not a consideration, virtually not a consideration at all. The best businesses, by definition, are going to be businesses that earn very high returns on capital employed over time. So by nature, if we want to own good businesses, we're going to own things that have relatively little capital employed compared to our purchase price. That would not have been Ben Graham's approach. But Ben was not working with very large sums of money, and he would not have argued with this approach. He just would have said his was easier. And it is easier, perhaps, when you're working with small amounts of money. My friend Walter Schloss has hewed much more toward the kind of securities that Ben would have selected, but he's worked with smaller amounts of money. He has an absolutely sensational record, and it's not surprising to me at all. I mean, when Walter left Graham, though, I would have expected him to do well, but I don't look at the primary message from our standpoint of Graham really as being in anything to do with formulas. In other words, there's three important aspects to it. One is your attitude toward the stock market. That's covered in Chapter 8 of The Intelligent Investor. I mean, if you've got that attitude toward the market, you start ahead of 99% of all people who are operating in the market, so you have an enormous advantage. Second principle is the margin of safety, which again gives you an enormous edge and actually has applicability far beyond just the investment world. And then the third is just looking at stocks as businesses, which gives you an entirely different view than most people that are in the market. And with those three sort of philosophical benchmarks, the exact evaluation technique you use is not really that important, because you're not going to go way off the track, whether you use Walter's approach or Walter Schloss's or mine or whatever. Phil Carre has a slightly different approach, but it's got those three cornerstones to it, I will guarantee, and believe me, he's done very well. Charlie?
Yeah, to the extent that the method of estimating future cash flow requires projections, I would say that projections, while they're logically required by the circumstances, on average do more harm than good in America. Most of them are put together by people who have an interest in a particular outcome, and the subconscious bias that goes into the process and its apparent precision makes it it's fatuous or dishonorable or foolish or what have you. Mark Twain used to say, a mine is a hole in the ground owned by a liar. And a projection prepared in America by anybody with a commission or an executive trying to justify a particular course of action will frequently be a lie. It's not a deliberate lie in most cases. The man has gotten to believe it himself, and that's the worst kind. So I don't think projections are to be handled with great care, particularly when somebody has an interest in misleading you.
Charlie and I think it's fair to say we've never looked at a projection in connection with either a security we bought or a business we bought. We've had them offered to us in great quantities. Now the fact that we voluntarily turned them away when people have tried to thrust them upon us. I mean, the very fact that they are prepared so meticulously by the people who are selling the businesses or by the executives who are presenting to their boards and all of that sort of thing, I mean, either we're wrong or they're wrong. I mean, it's a ritual that managers go through to justify doing what they wanted to do in the first place in about 9 cases out of 10. I have never met an executive who wanted to buy something that said, well, I had to turn it down because the projections didn't work. I mean, it's never happened. And there will always be somebody that will come up with the projections that will satisfy the guy who's signing his paycheck or who will sign the deal that provides the commissions. and they will pass those along to whomever else they need, the bankers or the board, to approve it. And it is total nonsense. I was recently involved in a situation where projections were a part of the presentation, and I asked that the record of the people who made the projections, their past projections, also be presented at the same time. It was a very rude act, and
it was regarded as apostasy.
But believe me, it proved the point. I mean, it was a joke. I mean, so we'll leave it at that.
And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate, because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case.